Hey everyone, it's Imran from Options Insight, your macro options daily. All right, so S&P, everything pretty much giving back a bit yesterday, getting a little wake-up call with the market as a stronger US ISM services kind of poked holes in this whole Fed pivot, Fed pause narrative and reversed some of that bullish price action that we saw on Friday. As usual, European stocks kind of snoozing as they have been, not moving anything like what we're seeing in the US. And then China even took a bit of a breather, but China looks pretty strong overnight, rallying another 2-3% as we continue to get more and more good news with regards to them lifting restrictions and actually letting their people have a bit more freedom in their lives. So that's good news, and the Chinese reopening story continues to gain traction. Commodities did sell off across the board, about 1 to 2 sigma type moves there in commodities. Big moves, uranium down 5, nat gas down 10, but generally the whole space softer. Oil did try and rally initially, but then got whacked. Now looking over at vols, we're seeing a good bounce in US indices. It's up about 2 vols there. European not doing anything, obviously, because spot's just kind of doing nothing. Asia vols also drifting down a little bit. Commodities generally firmer in terms of vols, except for silver, which was down a point, but that had rallied quite a bit last week on that big 8% rally. Silver actually giving back 4% yesterday, so giving back half the rally that it managed last week, giving 50% of that back in a day. So it was a pretty dramatic move back down in silver. And then nat gas, despite being down 10% on the day, implied vols are down 7 vols, which is pretty unbelievable for a 10% move. I mean, even when the implied vol's at 100, so it's not pricing in 10%. A 10% daily move would be 160 vol. We got a 10% move, and yet they still smashed the vol down 7 points. So, I mean, it's pretty impressive the kind of swings we're seeing both in spot and vol in nat gas. But we're basically seeing that vol down 20 vols on the week, and we're seeing spot down 23% on the week. So nat gas is an animal. Now, those of you who subscribe to our overlay portfolio will know we've got a position in nat gas, which has been a bit of a roller coaster. But so far, touch wood, we're surviving. We're making a bit of money out of it. We'll talk a bit more about that later on in the video. Now, carry-wise, becoming a bit of a consistent pattern where you've got negative carry coming in the US indices and pretty much positive carry everywhere else within the equities landscape. I suspect that condition is going to remain until after December OPEX, where things might kind of clean out a bit. And then we're going to go into that Christmas period, which is seasonally quiet. And we may just get like a bit of a snooze fest across all markets where realized vols just tumble and we don't really see a lot going on. And then outside of equities, we are seeing precious metals with a bunch of negative carry. So long gamma working pretty well in precious metals. But otherwise, in energy commodities and stuff, it's still not really realizing. And same thing in copper. With copper vols up near 30, it's only managing to realize 20 right now. So copper not really a long gamma of choice. Looking at skew, bit of a mixed picture in equity skew, bit of a bid on S&P skew as the market came down, obviously triggering a little bit of hedging flow. Europe skew still looking rich. Thinking that's a bit of a sell, to be honest, given how Europe's realizing and doesn't seem to want to react to any kind of moves lower in risk assets. That's probably a bit of a sell, and that probably does continue to come in if risk premium continues to come in general over the next month after FOMC is out the way. So there might be an opportunity in selling European skew there. I wouldn't say I'm rushing to do it just because I know Europe is sitting up at the top of the range and we might suddenly get something out of Europe to trigger a pullback. So I think that's why skew is inflated, but it has got room to come down given that it's realizing so poorly. And compared to US skew as well, it's a fair amount higher. If we look at commodity skew, nat gas moving, so upside getting slammed there. So that skew is negative because the call's over. And you can see that's done 7 volt points in terms of what the 1 month 25 deltas have moved over the course of the last week. So that's calls becoming less expensive than they were by about 7 vol points. So that's a dramatic move. And if you think the at the money vols down 20 vols on top of that, well, that means the upside call vols are getting absolutely destroyed in nat gas. Okay. Obviously, people thinking that upside tail is kind of been removed. probably because of the weather and kind of what they're seeing there in terms of patterns of what sort of temperatures are likely to be like. Uranium and oil skew also softer, down about a vol point apiece. And that's interesting because spot was down pretty hard, right? You had oil down 3%, you had uranium down 5%. In those type of spot moves, you'd expect there'd be some demand for puts, but if anything, puts are getting relatively sold. So that suggests that people are using the weakness in spot in those two commodities to actually come and buy calls or sell puts. And so that's what we call a divergence. And I often look for that. I often look for skew to be diverging from what spot is doing to maybe give a bit of a lead indicator, right? Some of the sophisticated option players in the market are basically leaning against the spot move in the options market. And that sets up well for the idea that oil may have a rally coming early next year as everyone just kind of accepts that China really is reopening, and we see that supply is still relatively tight, right? So remains to be seen if that's what's going to play out. And also the uranium story clearly got very positive fundamentals longer term, but when is uranium actually going to do what people think it should do and kind of go up by at least 50% plus, right? I think a lot of people like that trade and think that is the trade longer term, but we need some kind of catalyst to get that trade going. And right now doesn't seem to be materializing. So if you're parked in uranium and if you're in options, you probably want to have them at least sort of 6 months long, 6 months duration or longer to give yourself plenty of time for that thesis to play out. All right, so that's the general summary. If we now move on to kind of what's happening. So yesterday's move lower in markets, obviously, like I said, was ISM services print coming in pretty strong. And that's suggesting that we may get stickier core services inflation. And that seems to be the key measure that Powell is now going to be looking at, right? They've stripped inflation into 3 different components. 2 of them have already rolled over, it seems, from the good side of things. And now they're looking at services ex shelter. So that's basically core services. And if ISM services is as strong as it is, then that may suggest that's going to take a while for that number to roll over. Last week's payrolls obviously were shrugged off by the market, but this was the second sign of a resilient US economy. So we got reverses in the dollar weakness that we've been seeing. We got yields having a decent bounce from the local lows. And whilst the 50 basis point hike is priced in for December FOMC, and it's at 80% probability, we may be opening up for much more uncertainty around what comes in February's meeting, okay? And, that was being thought of as about 25 basis points as they slow the pace down, but they might open up room for that to be a 50 or even a 75 if CPI was to come in high next week. There's a lot of uncertainty around that, and that's going to probably keep markets relatively volatile. It's probably going to keep interest rate markets relatively volatile as well. Now, another interesting observation from Morgan Stanley research is that much of the selling that we've seen in recent months has come from retail. Okay, so they have various measures they look at to try and track retail flow. And what they're basically saying is that over the last 3 years, retail have bought a staggering amount of exposure to single stocks in the US, something like $250 billion. Now, we have started to see selling. So you can see here that... see these bars show that retail have been selling over the last few months. And the last time we had sort of 3 straight months like that of selling was back in late 2018. And we all know what happened to the market there, right? So anyway, the question is, has retail capitulated? According to Morgan Stanley, given the amount of exposure that they bought over the last few years, if you were to compare the capitulation to think that they're done, if you have compared to what happened in late 2018 in Q4, they potentially have got another $100 to $150 billion of exposure that they would still need to sell out of for a full capitulation. So that means there may be more selling to come. And that means the Santa rally that some people are hoping for might struggle to materialize if these guys are selling in force like we've been seeing over the last few months. So something to be aware of there in terms of retail, because that whole buy the dip mentality that we think is ingrained in people's minds, that is a retail phenomenon as well as an institutional, and retail don't seem to be buying the dip right now. So that's what we're seeing. Lastly, from Morgan Stanley as well, Mike Wilson, obviously their strategist, has been calling this year's price action pretty well, almost as well as Mike Hartnett over at Bank of America. He's basically bailing out on his tactical long view. He was looking for 41.50 on the S&P. We got pretty damn close. He now doesn't like the risk reward of being long equities up here. He sees earnings rolling over pretty damn sharpish next year. He sees inflation collapsing as well. But he thinks even though inflation is collapsing and it means it takes the pressure off the Fed to hike rates, he thinks the destruction in earnings that we're going to see is going to be the biggest driver, and it's going to tank margins and it's going to take stocks lower, basically, right? So he's really basing his bearish view on on stocks, on the idea of earnings and valuation being priced back down, right? And the pivot not being enough to stop that dynamic, right? And you'd also need to probably see unemployment spike considerably, and he expects that as well. And if we see that, that probably takes some passive flows out of the market and kind of does help that view for lower stocks. So it remains to be seen, but this guy's been calling things pretty well on the fundamental side. All right, so what else are we looking at? So for those of you who have checked out our new product, which is our joint venture with 42 Macro, it's the options overlay that we're doing for their portfolio construction. For those of you who watched that video that we released yesterday, we talked about upside calls on the NASDAQ. So why are we looking at upside calls on the NASDAQ? Well, we're basically saying that next week's CPI is the next major catalyst for the market. So whilst we might get a drift back down in markets over the course of this week, the big one, the big data point that the whole market cares about right now is CPI, right? And we saw that last month CPI triggered 5 sigma moves on the day. It was pretty unbelievable. And even Powell ushering a few words of dovishness last week triggered massive moves in the market. So clearly the market is in a state of, let's call it disequilibrium, where if there's a marginal bit of news around inflation, it's moving things quite dramatically, right? Because I think liquidity is kind of diminishing, and there's a lot of algos that are trading on those type of data points. And also you've got the whole zero DTE crowd that comes in on the day of a big data point and just pushes the market. And it seems like the volume and the size that they're trading is overwhelming the market, and it is accelerating moves once that data point comes out. That seems to be the dynamic that we're seeing. So anyway, we had a look at the type of assets that are performing on these sort of these data points. And basically, we saw that NASDAQ is the one where you're probably going to get the most bang for your buck on a vol-adjusted basis. So for a simple trade, if you need an upside hedge, because you're underweight, you're probably going to buy calls on Triple Q, which is the NASDAQ ETF. You could buy December calls, you can buy January calls. But generally, we think buying calls in that kind of 10 to 15 delta region makes sense. And whether you want those calls into year end because you believe a Santa Claus rally can happen, maybe you buy Jan. If you just think the spike happens on CPI and then it's done, and then maybe Powell walks the market back down in FOMC the day after, maybe you stick to December calls and then you just get rid of them on the day of CPI. Those are the sort of different ways that you could play that. But the trade that's looking interesting to me is the relative value trade between Triple Q and the ARK ETF. So clearly the ARK ETF has been squeezing pretty hard as well when you get these lower inflation prints or you get these dovish words from the Fed, because ARK is very sensitive to interest rates as well. But if we look at how those things are performed, so looking at the chart, you can see that you've on the November CPI, you had a massive spike in ARK of around 20-25% in a matter of days. Now, NASDAQ was rallying, but more like 10%, right? So NASDAQ got up to here, ARK got up to here. But over the course of the following few days, look at how much ARK drifted back down. So then it was like they were both in line and they're both up around 6%. Then they were kind of trading in lockstep with each other. Then we had Powell's dovish comments last week, and we had another knee-jerk higher. But look at the kind of explosiveness of ARK. It wasn't as dramatic as before. So you had NASDAQ up 5, you had ARK up, but it wasn't up stupid amounts, basically. Okay, and again, since then, ARK has drifted back down to be more in line with Qs, and they're both up 8 to 9% apiece. Okay, so what I'm basically saying is you get the knee-jerk move up. ARK tends to outperform on the knee-jerk, but then over the course of the few days, they tend to pretty much move by the same amount. Okay, so that presents to me an opportunity. So the trade that I would do is take advantage of the spread between the implied vols between ARK and the NASDAQ. Okay, so if we look here, you can see a regression between ARC and the triple Qs shows us that they're very positively correlated. Okay, the correlation, 60-day rolling correlation on these things is around 80%. So when you're doing spread trades, you want to make sure that the correlation is quite high between the assets that you're trading. Okay, that gives you more confidence in doing the spread trade in the first place. Then we look at the beta on ARC, and the beta is coming in at around 1.77. So that means ARC in general is kind of moving just under 2 times what triple Qs is doing on a daily move sort of basis, which is fair enough, right? That's kind of what we thought anyway. Now you look at the implied vols, and this is our cross-asset kind of vol and skew matrix. You can see that NASDAQ vols are down here in the kind of mid-20s, and ARC vols are up here above 50, okay? But that's kind of in line, right? That's kind of double the implied vol, means double the move that you expect. And we're kind of saying that the beta is somewhere around 2 or just under 2. So it's not like the implied vols are completely out of whack. They're in line with the kind of betas that we're seeing. But because of the chart that I just showed you, you can see that whilst on a daily basis, ARC might move double, over the course of multiple days or weeks, they are kind of moving in line with each other, right? So the idea is we're not going to do a gamma spread where we sell vol on ARC and we hedge it every day, and we buy vol on NASDAQ and we hedge it every day, and we're trying to play that daily realized, because that's not where the opportunity is. Where we think the opportunity is buying calls on NASDAQ and selling calls on ARC, doing it in a ratio, because the vol is so much cheaper on NASDAQ, you get to buy multiple calls on NASDAQ, and thereby you get a net long delta position without having to pay for it. And we think that if we were to get dovish news out of CPI, and Powell doesn't give you a disaster on his press conference, and markets want to rally into year end, NASDAQ will probably rally pretty damn hard. And it may even break its 200-day moving average. Whereas ARC, we think because ARC is full of low quality growth, it's not mega cap tech. It's not your FANG stocks. It's not the guys that are cash machines that print loads of money that the whole world likes to buy when they think they've got the all clear to buy tech. The first thing people are going to fly back into, in my opinion, is not the rubbish quality names. Those are the most shorted names that people hate, and they've already been squeezed, right? And people have already covered some of those shorts. But if people are going to buy if people are going to buy tech into year end, I think they're more likely to want to buy NASDAQ than ARC. So I believe that ARC doesn't squeeze quite as hard as it did on that CPI last month. And I think having the relative value trade where you own calls on NASDAQ, as many calls as you can, versus selling some calls on ARC to be premium neutral, is a really nice way to get exposure to a rally if it was to come, not have to commit to the rally because you might be bearish. You might think that CPI is probably going to come out quite hawkish, but just in case it comes out light, you know what type of dynamics we see in the market, and you know that there's a good chance that this thing squeezes. All right, thanks a lot for listening, guys, and I'll catch you tomorrow.